Imagine this. You walk into a speed dating event where everyone is wearing a name tag that reads not "Hi, I'm Sarah" or "Hi, I'm Jake," but "Hi, I'm Apple" or "Hi, I'm Tesla." The room is buzzing with energy, hearts are racing, and every single conversation is high stakes. Only here, instead of exchanging phone numbers, people are exchanging billions of dollars. That, my friends, is the stock market. A place where attraction, fear, and hype matter just as much, if not more, than cold, hard fundamentals. And here's the kicker. This isn't just a metaphor. The stock market really behaves like a high-stakes speed dating game. Investors don't carefully analyze compatibility over years. They swipe right and left in seconds, often based on nothing more than vibes. A CEO coughs weirdly in an interview, swipe left, stock tanks. Rumors spread that a new product might be revolutionary, swipe right, stock skyrockets. Today we're going to unpack why the market looks less like a classroom of economists and more like a rowdy dating event on steroids. But first, let's challenge a sacred assumption. Everyone tells us markets are rational, driven by data, math, and efficient pricing. Professors call it the efficient market hypothesis, suggesting that stocks are always priced perfectly based on all available information. Sounds elegant, doesn't it? Too bad reality laughs in its face. If you've ever seen a stock rocket upward on a meme or nosedive on a rumor, you know we're dealing with raw emotion, not rational calculation. So why cling to the myth? Because people hate admitting money is ruled by psychology. And this is the mystery at the heart of our story. How did the stock market, which should be a careful, measured system of long-term ownership, turn into a frenzied carnival of hot takes, short attention spans, and instant attraction? Why does it look more like speed dating, where each stock gets only a few seconds to impress, than like marriage, where investors commit for life? The answer lies in its origins. Because from the very beginning, markets weren't designed for calm judgment. They were designed for human drama. Let's rewind the clock to Amsterdam in the early 1600s, where merchants weren't just trading tulips and spices, they were inventing the first modern stock exchange. The Dutch East India Company, founded in 1602, needed enormous funding for voyages that took years to pay off, so they sold shares, allowing ordinary citizens to date the company by owning a slice of it. Suddenly, wealth wasn't just about land or gold. It was about paper slips that said, "I have a relationship with this company." And once that started, the sparks never stopped. Picture the scene. Crowded taverns and coffee houses, where ordinary citizens clutched their shares like love letters, whispering rumors about the company's next big voyage. One day, the stock soared because a ship returned loaded with spices. The next day it plummeted because pirates were rumored to be circling. No calculators, no Wall Street terminals, just human excitement, fear, and gossip. The entire market resembled a chaotic singles mixer, where everyone hoped they were holding the most attractive partner, while secretly panicking that someone else might steal them away. What this shows us is critical. From the very beginning, markets weren't cold, rational machines, they were living, breathing social theaters. People didn't just invest for profits, they invested for status, reputation, and the thrill of belonging. If your neighbor got rich, you wanted to join the party. If rumors spread of losses, panic swept the room. This wasn't about spreadsheets, it was about feelings. And just like in speed dating, decisions were fast, emotional, and often regrettable. The DNA of the stock market was emotional matchmaking, not math. Write any lettering inside the frame. Fast forward to the roaring 1920s, where Wall Street took this matchmaking frenzy to dizzying new heights. America was booming. Radios, cars, movies, jazz. The country was in love with progress. And the stock market? It became the ultimate singles bar. Cab drivers, shoeshine boys, and even farmers were pouring money into stocks, convinced they'd found their dream partner. People weren't analyzing balance sheets. They were chasing excitement. Stocks soared, not because companies were making record profits, but because everyone believed someone else would want their date tomorrow. Imagine the ballroom. Thousands of people dressed to the nines, champagne flowing, jazz bands playing, and everyone screaming, "Pick me, pick me." The stock prices spiraled higher and higher in a fever of desire. Buying a stock wasn't about stability or long-term compatibility. It was about scoring the hottest date in town before someone else did. And when everyone acts like that, the bubble grows. It's no wonder Wall Street in the 1920s felt like a love affair spiraling out of control. But every wild romance has an ending. That ending came in 1929, when the music stopped. Suddenly, everyone wanted out. Imagine every guest at that grand ballroom deciding, in the same instant, that their date wasn't attractive anymore. Panic spread, partners were dumped en masse, and the floor collapsed beneath them. The Great Depression wasn't just a financial collapse. It was the collective heartbreak of an entire nation. People had been chasing quick thrills instead of lasting value, and when the illusion shattered, the consequences rippled across families, jobs, and futures. The hangover was brutal. Out of that chaos came a desperate need for order. The US government stepped in like a stern parent after too many bad dates. New regulations demanded companies disclose real, verifiable information. Investors had to be told the truth, no more catfishing. The Securities Act of 1933 forced transparency, while the Securities and Exchange Commission, created in 1934, became the market's referee. Suddenly, investors couldn't just fall for glossy promises, they had to actually read the fine print. But let's be honest, did that stop the drama? Not a chance. Because here's the problem. No matter how many rules you add, you can't regulate emotions. You can force a data to reveal their real age or job title, but you can't stop someone from falling head over heels based on charm alone. And in the market, charm comes in the form of hype, trends, and stories. Even with the SEC in place, investors still got swept away. They still bragged about big wins and whispered about losses. Regulation fixed the paperwork, but it didn't fix human hearts. By the 1950s and 60s, the stock market looked more stable. Pension funds and mutual funds encouraged people to think long-term. Investors felt like they were finally settling down, trading one-night stands for marriages. Companies like IBM and General Motors became household names, steady and reliable partners. But even in this golden age, the seeds of temptation were still there. Investors couldn't resist the lure of the next big thing because deep down the market isn't about commitment, it's about the thrill of what's coming next. Then came the 1980s, when Wall Street found a new toy: computers. Algorithms and quantitative models promised to take the guesswork out of investing. Suddenly, it wasn't just people swiping left or right. It was machines doing billions of swipes per second. At first, this seemed like progress, like hiring a professional matchmaker to pick the best partner. But when 1987's Black Monday hit, we saw the dark side. One computer triggered selling, then another, until the whole system panicked. It was a speed dating stampede. Think about it. If speed dating is chaotic with humans, imagine replacing them with machines that have no patience, no emotions, and no sense of wait. Let's talk this through. That's what Wall Street built. An automated frenzy. Black Monday wiped out 22% of the market in a single day, and the lesson was clear. Machines don't fix human flaws, they amplify them. Instead of eliminating drama, algorithms turned up the volume. And as we'll see, that pattern repeats again and again throughout history. The late 1990s gave us one of the wildest dating parties in market history, the dot-com bubble. Suddenly, if your company had .com in its name, you were instantly hot property. Investors lined up like suitors chasing a prom queen. Companies like Pets.com, with little more than a mascot and a website, became overnight sensations. Billions poured in, not because of profits or stability, but because everyone assumed someone else would fall in love tomorrow. It was swiping right on every single profile, just to avoid missing out. And just like any fling built on appearances, it ended badly. When investors realized many dot-com companies had no actual business models, the breakup was brutal. Stocks crashed, fortunes evaporated, and hearts were broken. Yet even in the wreckage, people insisted, this time it's different. But it wasn't. The same emotional cycle repeated: attraction, obsession, disappointment, heartbreak. The only difference was the backdrop: first tulips, then industrial giants, then internet startups. The objects of affection change, but the human behavior stays exactly the same. Next came the housing bubble of the early 2000s, a romance built on lies. Banks packaged risky mortgages into shiny securities, selling them off as if they were attractive, dependable partners. Investors around the world lined up, convinced they'd found the one. But when homeowners couldn't pay, the truth came out. These partners weren't faithful. The collapse of 2008 wasn't just a financial crisis, it was a messy global divorce with custody battles fought over jobs, homes, and futures, and the pain rippled across every corner of society. What's staggering is how predictable it was. Just like in dating, people ignored red flags. Risky loans? It'll be fine. Skyrocketing housing prices? Love conquers all. But when reality hit, the heartbreak was devastating. Banks failed, families lost homes, and governments scrambled to patch the wounds, and once again regulations were introduced to prevent the same mistakes. But as history shows us, the fixes rarely address the core issue. Markets behave like people, and people fall for charm, hype, and dreams over and over again. Which brings us to the modern era. Meme stocks like GameStop and AMC in 2021 made it crystal clear. The market is less like a long-term marriage and more like a chaotic singles bar powered by social media. People weren't buying these companies because of financial fundamentals. They were buying because the crowd was buzzing, because Reddit said it was cool, and because they didn't want to miss the party. It was digital speed dating on a global stage, thousands of investors swiping in sync. Some walked away with fairy tale endings, turning a few $100s into tens of thousands. Others were ghosted, left holding stocks that plummeted after the hype faded. The parallel to dating couldn't be sharper. Sometimes you meet the one, sometimes you get catfished, and the shocking data proves the point. In the 1960s, the average stock was held for nearly 8 years. Today, less than 6 months. That's not investing, that's serial dating. Chasing sparks instead of building long-term compatibility. Even the professionals aren't immune. Hedge fund managers, supposedly the smartest people in the room, often underperform simple index funds. Why? Because they too are driven by fear of missing out and fear of loss. Behavioral finance studies confirm it. Humans hate losses twice as much as they love gains. They follow the herd, and they convince themselves that this time is different. In other words, they act exactly like people at a speed dating event. Impulsive, insecure, and desperate not to be left behind. Algorithms which now dominate trading don't solve this problem. They magnify it. Machines are programmed to chase momentum, to exploit tiny shifts in attraction. They don't think long-term. They don't care about fundamentals. They swipe endlessly, faster than any human could. The result is a market that looks less like marriage and more like a casino, with lightning-fast swipes deciding the fate of billions. The tragedy is that long-term value still matters, but it gets drowned out in the noise of short-term speed dating chaos. So what can we learn from all this? 3 things stand out. First, the stock market is a mirror of human psychology, not a calculator of perfect value. It reflects our desires, fears, and emotions more than it reflects cold data. Second, every boom and bust follows the same cycle: attraction, obsession, disappointment, heartbreak. The objects of desire change, but the pattern doesn't. Third, if you want to survive, you can't treat stocks like speed dates. You need to treat them like marriages. Patience beats thrill. And here's the warning. History will keep repeating itself because human psychology doesn't change. Whether it's tulips, .coms, or meme stocks, people will always fall for the excitement of the crowd. The market will tempt you with love at first sight, but if you chase every spark, you'll burn out. The heartbreak can be devastating, not just financially, but emotionally. So the question isn't whether another bubble is coming, it's whether you will recognize the pattern before getting swept away in the frenzy. So here's my challenge to you. The next time you hear about a hot stock, a can't-miss opportunity, or a social media frenzy, stop and ask, am I investing or am I just speed dating? If you want to win, play the long game. Find stocks that are compatible for decades, not days. Build relationships, not flings. That's how fortunes are made and heartbreaks avoided. And if you enjoyed this wild ride through the love life of the stock market, hit like, subscribe, and share, because we've got plenty more stories coming.